Welcome to The Explainer. We hear all the time that businesses are getting more sustainable. But what if the way we've been measuring that is, well, just not telling the whole story? Today, we are looking at a brand new corporate scorecard that reveals this really fascinating tension between what companies say they value and what they actually protect. Let's get right into it. I mean, think about it. The word sustainability is everywhere. But what does that actually mean when we're talking about a huge company? Is it about their carbon footprint? How they treat their people? Is it just about being financially sound? For the longest time, the answer has been, well, pretty fuzzy. But things are changing. The old scorecards, the ones that only cared about profit, are starting to look pretty old-fashioned. There's this big push, driven by new regulations in the European Union like the CSRD, that's forcing a much, much bigger picture into view. It's a real game changer. So that brings us right to our first section. What exactly is this new business scorecard? So why are we talking about this right now? Well, take a look at this. Interest in this very topic basically went vertical after 2021. Research shows this huge spike in attention from, academics, regulators, you name it. This isn't some dusty old idea. Its time is right now. And at the absolute heart of this whole shift is a concept called double materiality. It sounds complicated, but it's actually pretty simple. It's all about looking at sustainability from two different directions. First, how is the outside world, things like climate change or new social trends, going to affect the company's wallet? And second, how are the company's own actions going to affect the world and the people in it? Exactly. You can think of it like a two-way street. On one side, you've got what's called financial materiality. That's the outside-in view, the world's impact on the company. On the other side, you've got impact materiality. That's the inside-out view, the company's impact on the world. And double materiality says, nope, you can't just pick one. You have to look at both. Okay, so theory is one thing, right? But to really get a feel for this, we need to see it in the real world. So for our next section, we are going inside Spain's biggest banks to see how this new scorecard actually plays out in practice, all based on a really fascinating case study. The research we're looking at today zeroes in on the 5 biggest banking groups in Spain. And this is great because it takes us out of the clouds of abstract theory and plants us firmly on the ground, looking at the actual, real-world choices of these massive financial players. And here are the players we're talking about. I mean, these are the heavyweights of Spanish finance, Santander, BBVA, and CaixaBank, right alongside Sabadell and Bankinter. These are huge global institutions, so what they decide is important. That gives us a really telling snapshot of the entire industry. All right, and this brings us to the real core of the research. When these giant banks sit down and do their double materiality analysis, what do they actually decide is important? What makes the final cut? So the research team did something really cool. They crunched all the numbers from all 5 of these banks' sustainability reports, and they created this sort of average materiality matrix for the whole Spanish banking sector. So the big question is, what did they find? Okay, so before I show you the results, here's a super quick guide on how to read what's coming. The vertical, up and down y-axis, that measures the bank's impact on the world. The horizontal, side-to-side x-axis, that measures the world's impact on the bank's finances. So basically, anything that ends up in that top right corner is what they consider a huge deal on both fronts. And here it is. This is what they found. Out of 12 key sustainability topics they analyzed across all the banks, only a quarter of them, just 3, landed in that high priority zone. Meanwhile, a massive 2/3 were considered low priority. So what on earth is in that top 25%? So what made the cut? Well, 3 topics came up again and again as being high priority. Climate change, protecting the interests of their customers, and making sure their own corporate governance and ethics were solid. These are the issues that the banks clearly see as 1, a major financial risk to themselves, and 2, a major area where they have an impact. But what's just as telling, maybe even more so, is what didn't make the cut. Things like protecting biodiversity and natural capital, promoting diversity and inclusion, and, get this, even the whole category of sustainable finance itself were all consistently ranked as having minimal or just sort of informational importance. And this contrast is it's incredibly revealing, isn't it?
So, in our next section, let's really dig into why this new scorecard matters so much and what these priorities are telling us about the bigger picture.
Because what this reveals is a really clear tension. On one hand, you have the banks laser focused on things that directly hit their bottom line and their reputation, governance, financial risks from climate change. But on the other hand, these bigger, broader issues like their actual impact on ecosystems or social equity, they're just seen as way less critical. And it just goes to show you that this whole system is still a work in progress. There's a perfect quote from the research that sums it up. It says that even though regulation has pushed for more transparency, how each bank actually calculates these things still varies all over the place. The scorecards exist, but it's kind of like everyone is still making up their own rules to the game. All right, so after looking at the theory, the case study, and the pretty stark results, what is the big takeaway from all this? What do we walk away with? Here's the bottom line. Double materiality. It's not just another regulatory headache for companies. It is a powerful new lens for every single one of us, whether we're investors, customers, or employees. By forcing a company to actually put its priorities down on paper like this, it gives us this unprecedented look at what it truly, deeply values. And it cuts right through all the marketing fluff. And that leaves us with a final thought, a challenge, really. This whole framework empowers us to ask a much smarter question. So the next time you look at any big corporation, don't just ask, are they sustainable? Ask this instead. What does their double materiality matrix look like? What are they prioritizing? And maybe even more importantly, what are they choosing to overlook? The answer to that? It will probably tell you everything you really need to know.